Good evening, everyone. Thank you so much for the invitation. I will start by confessing that I don't speak a word Italian, so there is a non-zero probability that I will just repeat anything that has been said before, so apologies for that. I'm working on it. So it's good to see such a diverse audience. I also see many students, suspiciously many almost. Did you force them to attend?
Not at all, because they just received credits for that, so it's a spontaneous.
Well, the future of the field is ensured. That's well, it's good news. I was just informed by my fellow panelists that you actually have a dedicated program to social investments here at the university, which is I find amazing. 15 years ago in my university, this was unthinkable, and I think even today it would be unthinkable in many universities. So, congratulations on being ahead of the curve. So I will start by introducing myself. My name is Wouter Torfs. I think I'm the appropriate bridge between the previous session and this session because I myself have an academic background, but I am doing research right now in an institution, the European Investment Fund. I'm an economist at the research division, and I work on social topics, hence my attendance here. So I will give a brief overview of what is the EIF, the European Investment Fund. So, our philosophical mandate, let's say, is related on two main pillars. They're both related to one another, but allow me to introduce them. So the first one relates to a market failure that is present in the market of external financing. And this market failure relates to the presence of asymmetric information between the financier on the one hand and the financed individual company on the other hand. This market failure results in what they call sometimes the SME financing gap, because it's particularly relevant for SMEs. So that means there is a supply shortage for a given demand, which is a market failure and introduces welfare. So one of the mandates, the general mandate of EIF is to provide this risk financing to SMEs across Europe. So the other one is more related to specific policy targets. So we have a general mandate to provide finance, but we also help the European Union to achieve their policy objectives. So for example, this can be promoting innovation, but this can also be, and very relevant for this topic, to try to help them to achieve their social targets. So important in the global impact investment market, I wanted to compare, okay, is this so for all global regions? So I compare to European Union with the United States. And as we see, venture capital is much more important in the EU than it is in the United States. The United States maybe likes things bigger, therefore the private equity market is relatively more developed. So I think it's good for policymakers to know where the capital comes from. So the bottom graph takes a closer look at the venture capital market in the European Union. It plots the different sub-stages of venture capital investment. And it does so cumulatively. Why cumulatively? Because if you take just year data, they're very erratic and they jump a lot, so it doesn't give a lot of information. And there you see that the European Union's venture capital market is very much supported by late stage investments, not so much by early stage investment.
Buonasera. And I also would like to say thank you to Mario, even though he is on other business outside the room, for the kind invitation to speak at this conference. Let me share with you a bit of a puzzling introduction, which is whenever we speak with American colleagues about this field, and Wouter's data were evidence of that, they celebrate a multi-billion market that has a huge potential. And whenever we sit in a European committee or body on this issue, we talk rather in millions, and we are rather humble, and we are rather hesitant. I'd rather share with you an observation from the German NAB on where is the market niche for social impact investments, or put it in different words, where is the need in society for this new instrument? And our conclusion was that social impact investment in the German situation would be a kind of the R&D, the research and development segment of the public benefit sector, of on the one hand, non-profit sector, and on the other hand, of the sector that operates maybe on for-profit basis, but under social policy legislation, and that means under regulated quasi-market conditions. Why did we highlight this so much? We had a very clear agreement in this National Advisory Board that we would not regard it as our mission to substitute social impact investment for what we still see as an existing welfare state. We did not accept a mission that our discussion would be about dismantling the existing welfare state. Our discussion would be about identifying an appropriate level of complementarity, that is, identifying segments of markets or niches where existing social policy regulation would not cover the need. And we clearly identified that the most relevant gap in this regard was the funding of innovation, was the financing of investment in research and development, and that is in new approaches of problem solving.
First of all, I'm discussing something that is an application. So, what exactly I'm almost in an opposite position of you, but which is good in some way. And you see there is an investment framework for cities, and I will explain why, and also I will explain where are we standing. In general, when we talk about impact investment and measurement of impact investment, you have two schools of thoughts. One, they talk about aggregation, and another where you look about indexes, many that you consider a lot of different indexes for the impact. We have selected the aggregation one. We have selected also to measure output, not outcome. So, horrible. And so I will explain everything and try to convince you and the group here that we didn't do something so horrible as this sounds. So, first of all, what is our objective? Our objective was not to convince the investor that to invest in impact investment is good because they will go to paradise or they will do something morally good, but we are trying to demonstrate that in reality is a good investment. There is a return, and is a return that is comparable with what we have in the overall market. If there is not a comparison, which is quite good, it's not very good to invest in something like this. So, impact investment is something, I can see it here, sorry. I started to forget. So it's not what I write at the bottom, it's not a compromise. It's a decision that investors take because it's actually a good investment. There is also the additional part because you are investing, you have a return, but also you improve, for example, something in society or in your environment. So that is overall the package, but above all, our product or our model was to create, is to demonstrate that impact investment has a good performance and good as in the overall market. Okay, so given that the objective, we want to create a financial model that generate and capture and share value. That was the overall objective. We want the participation of the investor and the investee in the definition of the model. We need to have a complementarities of different funds and additionality. I will not explain because you have explained already what we mean about additionality. Okay, needed to combine, and when they talk about fund, this is it is the base of the fund. So if you want to create an investment fund, you have to create a portfolio of projects inside the fund. Usually, the fund that we have heard are usually they pick up a project like, okay, project 1, project 2, they are not connected. In this case, on the other hand, we create a portfolio that in some way created the combination between all the investment, and therefore we create a multiplier effect. Now, I will show you what I mean. Sorry, I'll go very fast now. So here is the dashboard that you will see, so it's completely transparent. So you see on the horizontal axis the financial impact, which is the financial return. In the vertical axis is the economic impact, so the one that we have evaluated. Let's call it non-financial impact, so the one that is aggregated, the minestrone. Okay, so each project is identified by two elements, the financial impact and non-financial impact. And the project will fall into one of these four areas. Either is no good, red area, is it good, green area, or it should be readjusted. Now, let's construct the portfolio. And I will not explain the equation of the portfolio because it's too late and we have to sign something. So, let's imagine this is true. So, these are real projects from the European Investment Bank. So, we have project one, which was a photovoltaic project for a city. So, project two, on the other hand, is a water. How do you say it in English? I started to forget also English. Water, yes, there's a sewage and water, also water cleaning. Then we have the wind power. Then we have another part of education, but for low-income people. A startup for digital startup. And this is an hotel with a shopping mall. As you can see, the projects some are in the green area and some are not. If I leave the project like this, the private sector will select only project 2 and 3 because are the ones that have financial return. The rest will go to the public sector.